Hello there and welcome to today's educational video. I remember when I first heard of short selling, I had so many questions. How does it work? How can some people make money when the share price goes down? And is it ethical that someone profits when certain companies or even countries are struggling? The goal of this video is to answer these questions one by one through examples and also cover what can go wrong in this process. So, first of all, what is short selling? Well, imagine that you have a friend who owns a rare collectible watch with a market price of $1,000. You believe that the price of this watch is about to drop significantly, so you borrow the watch from your friend, promising to return it in a month, and immediately you sell the watch for $1,000. In this case, you have correctly predicted and the price did drop and it's now $600. So you buy the same watch back at this lower price, return it to your friend, give him an additional $50 for the inconvenience of borrowing his watch, and pocket the difference of $350. No harm done, right? However, if you were wrong and the price went up, well, this would have been a terrible decision. Shorting a stock or another security has similarities with this simple example. Basically, it is the opposite of buying a stock or another security. You're speculating on the decline of the price. However, when you buy a stock, the downside is limited to what you paid for it. If it goes down to zero, well, you lose your initial investment. When you short a stock, on the other side, the losses are in theory unlimited, as the price can go up many times. To fully understand the process of short selling, we should also get familiar with the concept of margins. To short a position, one needs to have a certain percentage as a balance on their account that covers the losses if this short selling decision goes wrong. It is a collateral held by the broker, and if this margin is insufficient to cover the losses, that's what one gets margin called. Now, it is very important that short selling is very risky. So for those who are risk averse, this is definitely outside of your comfort zone. However, some individuals are risk seekers and not only do they short sell, but they also use leverage that multiplies the effect of the short selling decision. Oh, and by the way, do not borrow watches from your friend to sell it. It's just an example. Now, remember this example? Well, you pay $50 for borrowing the watch. There is interest to be paid when short selling stocks as well. This opens up a very legit question. Why at first would anyone bet that the share price will go down? Let's take a look at 4 very common reasons. The first one is a company might be fraudulent. If someone discovers that a company's financials do not add up, or the company is harming the customers, or it is just misleading its investors, then they could short sell its stock betting that the price will fall once the truth comes out. Is this legal? Yeah. Is it evil? I don't think so. If anything, this adds value to society. By exposing these bad actors, well, there's less future harm that will be done. A great example of this kind is Enron, and there will be more on that later in this video. The second reason is hedging. Investors that have long positions in stocks or other securities might use short selling as a hedge against potential downturns. This strategy mitigates losses if the market moves against their primary investments. So, is this evil? I don't think so. Let's take a look at number 3. Overvalued companies. Shorting companies of this kind means betting that sooner or later the price will fall to its fair value, and one can profit from that decline. Would you call this evil? I'll argue that this doesn't really harm the company or the society in the long run. It doesn't have any impact on the company's fundamentals, and if anything, should the price go down, it gives the management the chance to buy back shares at a lower price. And then we get to reason number 4. Betting on unprofitable, money-losing companies that might go bankrupt. Let's take a look at Tesla. It used to be a struggling, unprofitable company for years. It almost ran out of money. It was easy for short sellers to keep betting that the company would go bankrupt, which meant pushing the price down and subsequently decreasing the probability of raising funds. My personal take is that examples like this one show the dark side of short selling. There are plenty of money-losing companies out there, and there is always a chance that they'll turn things around. However, this chance decreases with the number of short sellers entering the picture. Now let's have a look at a few examples of the past when short selling went right, but also when short selling went wrong. And of course, we're going to start with the famous Jim Chanos and Enron. At the time, Enron was one of the largest energy companies in the world, and it was celebrated for its innovative business model and rapid growth. However, beneath the surface, the company's financial health was far from solid, a fact that Chanos and his firm discovered by going through its publicly available financial statements. What did they discover? Well, they discovered that the company was reliant on mark-to-market accounting, a method that allowed the company to book potential future profits on the day a deal was signed, regardless of the actual profits that might materialize. This, together with a high debt level and puzzling cash flows, did not align with its reported profitability, and convinced that the stock was overvalued and that these accounting practices were unsustainable, Chanos began shorting Enron. The share price, which peaked at $91 in mid-2000s, plummeted to less than $1 by the end of 2001. This scandal led to significant regulatory and legislative changes, including the so-called SOX of 2002, designed to improve corporate governance and financial disclosures to prevent similar frauds in the future. The second example I'd like to focus is coming from a different part of the world, from Europe, Germany. The name of the company is Wirecard. It involves billions of euros in missing funds, fabricated transactions, and regulatory failures. Wirecard was a German payment processor and financial services company that was founded in 1999. In less than 2 decades, it had expanded its operations worldwide and was included in the Germany's prestigious stock market index DAX. This signified its status as one of the country's top 30 public companies, and at its peak, the company boasted a market valuation rivaling that of Germany's largest banks. The Financial Times started publishing a series of investigative articles from 2015 onwards that questioned its accounting practices and reporting revenues. But it was not until June 2020 when Wirecard admitted that 1.9 billion euros held in trustee accounts in the Philippines likely did not exist. KPMG followed with an admission that failed to verify the existence of the cash balances, and this raised serious questions about the company's financial statements. The CEO resigned and was subsequently arrested on the charges including fraud, embezzlement, and market manipulation, and the company's filing for insolvency marked it as one of Europe's most notable corporate downfalls. What you will notice with these two examples is that the best short sellers put a lot of work into getting it right, and even then it might take years until the share price declines. John Maynard Keynes had a great quote saying that the market can remain irrational longer than you can remain solvent. This is a great quote when it comes to short selling. Don't forget, for the entire duration of the short position, interest is incurred on top of the potential increase of the price that needs to be covered. Now, what does the opposite look like? The GameStop short squeeze. Right, you might ask, what is a short squeeze? Well, it is the event of the price increase significantly forcing the short sellers to close their position, which means they have to buy back at a higher price and take the losses. But buying back only adds up to the upward pressure of the price, which makes it even worse for them. If we go back to the 2021, the original GameStop saga, it is a unique event in financial history, showcasing the power shift from traditional institutional investors to a new class of retail investors leveraging social media. The brick-and-mortar video game retailer had been struggling for years due to the shift towards digital game downloads and the impact of the COVID-19 pandemic. This led many hedge funds and institutional investors to bet against the company. However, Keith Gill shared his insights on Reddit and that GameStop is one of the most shorted stocks on the market, with the short interest exceeding the actual numbers of shares available for trading. Seeing this opportunity, other Reddit users started to buy shares and call options, driving up the prices, and this action put pressure on short sellers who were forced to buy shares to cover their positions, further driving up the stock price and creating so-called short squeeze. Fundamentally, of course, there is no reason for the share price movement. Today, as I'm recording this video, GameStop and other meme stocks are back in the news as Keith Gill started tweeting after more than 2 years and disclosed on Reddit that he is back with a significant position and even had a live stream that is very difficult to describe. At the end of the day, short selling is a tool much like any other in the financial world. Used responsibly, it can correct market imbalances. Used recklessly, it can cause harm. Thank you for following the video until the very end, and as always, in the next one.